first video for chapter 16 involves two problems that were on the warm-up. They are exercises 16.2 and 16.3, found on page 947 of your textbook. If we take a look at the problem statement here, I'm going to allow you to take a moment to read it. Please note that the company acquired bonds with a par value of $7,550,000, paying 6% interest semi-annually, and their 20-year bonds. The company uses the effective interest method to account for the investment, and they don't intend to hold the investment to maturity, nor will they actively trade the bonds. We also have information about the fair value of the bonds at the end of the first year. So let's get started with the four requirements. The first requirement is to determine the purchase price of the investment in bonds. In Intermediate 2, we learned how to do this on the liability side, calculating the value of a bond issued at a premium or a discount. In this question, we see that the bonds are paying 6% interest, but the market rate of interest is 10%. So we know that the bonds are going to sell at a discount. We also know that the bonds pay interest twice a year. So rather than using 10% for the required rate, we're going to use 5%. The number of periods is 20 years times 2 times per year, or 40 periods. The interest payment, I'm allowing Excel to calculate for me. It's 6% interest on an annual basis, so 3% of the par value twice a year. And the future value, the amount that's going to be paid back at maturity, is $7,550,000. Using Excel, we can see that the purchase price of the bonds is $4,958,978. I want to point out right now that on the quiz and on the midterm, you won't be required to do this calculation using Excel, the tables, or a financial calculator. I'm going to assume that you are able to calculate this amount, and it'll be given to you in the problem. However, from here on out, the rest of the processes that we go through and calculations are things that you'll be able to do. The second requirement is that we prepare the journal entry. We have the amount. The only question that we have here is which account to debit. Since we're not going to hold the bonds to maturity, nor actively trade them, they're classified as an available for sale debt investment. This is an asset account, so we debit it and credit cash. Requirement 3, or C, says prepare the journal entries to record the interest income for the first year. This requires us to create an amortization table. Remember that there are 2 interest payments per year, and we've calculated the cash interest as the par value times 6% times 1/2. This is the same value that we had on our previous slide. You'll also remember that using the effective interest method, the interest revenue, or the interest for the period, is the carrying value times the market rate. And finally, the discount amortization, the amount by which we're going to increase the value of the investment moving towards its maturity value of $7,550,000, is the difference between cash interest and effective interest. Once you've completed the amortization table, you can create the journal entries. We debit cash for the cash interest that we receive. We credit interest revenue for the effective interest. And the difference, the discount amortization, is debited to available for sale debt investments, increasing that account's value. Let's also take a look right now and see that at the end of the first year, the carrying value of the bond is $5,002,948. The last requirement is that we prepare the journal entry to adjust the investment's carrying amount to fair value at year end. So we look and see that the beginning balance in the available for sale debt investment account was $4,958,978, the present value of the bond at the time of issue. And when it's increased by the discount amortization, we have the investment balance of $5,002,948. When we compare that to the fair value of $5,197,500, we see that we have an unrealized gain of $194,552. This unrealized gain is credited through other comprehensive income. And we debit a fair value adjustment account that goes along with our available for sale debt investments in the amount of $194,552. We add the investment account balance and the fair value adjustment account balance together. We're now going to show the investment at its fair value. Let's continue on to exercise 16.3, which is where people had more trouble. And it really isn't a lot more complicated. We're just adjusting the bonds for their fair value at the end of year 2 and year 3. All right, at the end of the second year, the value of the bonds is $5,100,000. So we need to figure out where we sit at the end of year 1. And you'll remember that it was at $5,197,500. That was the fair value at the end of year 1. We also need to continue the amortization table through year 2, which is the first 4 interest periods. Take a look at the value in the bottom right-hand corner, $5,051,425. So before we make any additional adjustments, we have the available for sale debt investment account at $5,051,425. And the fair value adjustment account has a debit balance of $194,552, resulting in a total balance of $5,245,977. You'll see that the fair value of $5,100,000 is less than that. That means that over this period of time, the bonds have lost $145,977. So rather than having an unrealized gain, we have an unrealized loss. That's a debit to unrealized loss through other comprehensive income. And remember, it's going through other comprehensive income because it's an available for sale debt investment. And we credit the fair value adjustment account, reducing its balance. Our last requirement is to make the fair value adjustment for the end of the third year, assuming that the fair value of the bonds is now equal to $4,905,750. So let's remember where we were. At the beginning of year 3 or the end of year 2, the available for sale investment account had a balance of $5,051,425. And the fair value adjustment account now has a balance of $48,575. That's the difference between the gain recognized in year 1 and the loss recognized in year 2. This creates a fair value at the end of year 2 of $5,100,000. If we look at the amortization table through the third year, we now see that the carrying value is $5,104,872. To this, we're going to add the debit balance in the fair value adjustment account for a balance of $5,153, $5,153,447. If the fair value at the end of year 3 is only $4,905,750, then there was an additional loss in the current year of $247,697. We debit this to unrealized loss, and we credit it to the fair value adjustment account. This wasn't in the question, but I think it's useful to look. What's the value of the investment at the end of year 3? Well, available for sale debt investments from the amortization table has a value of $5,104,872. You'll see that value at the bottom right of the table. In the fair value adjustment account, we have the $194,552 debit from year 1, and then the 2 credits from years 2 and 3, resulting in a credit balance of $199,122. This reduces the carrying value to the fair value. So $5,104,872 minus the balance of the fair value adjustment account gives us a fair value of $4,905,750. I hope this video has been helpful. Please post your questions to the discussion board.